Tony Mood from St James's Place, you spoke at our BPR Masterclass this morning. Thank you very much for your contributions. You talked about some genuine client case studies which really rounded the day off very, very nicely. What sort of clients do you think are suitable for BPR? I think it has the reputation of being something that's very high risk, but then it does meet a very definite planning need, and some of your scenarios demonstrated that. So what are your thoughts on that?
I think the reality is that you have to deal with, and you cannot ignore the fact that these are high risk investments. I mean, our regulator gives us very strong indications that we must make it clear exactly what potential investors are getting into, which is fine. And I think we, like most advisors, will ask clients to sign declarations that not only points out the risk to the investments, but the type of returns that they may expect and the risks that they're taking with their money. So ultimately it's about communication. There is a huge danger in trying to categorize clients as to those who will and those who won't be appropriate for it. I mean, the case studies that I used today, in both of them, the clients actually, even though they had a reasonable amount of money, weren't sophisticated people. And that's why we very much were looking at only a relatively small percentage of their portfolio to do the job that it needed to do, rather than actually looking at too much. So it's about communication, getting your message across to the individuals that this is what the advantages are, but this is the risks you're taking. Now, that being said, there are scenarios where actually, interestingly, there can be little other option. And BPR is quite almost unique in this respect. If you have someone who literally has left inheritance tax planning till far too late, it can be that the ability for someone to invest in something for a 2-year period, for it to be exempt, is the only thing that they can do. And I think under those circumstances, clearly you still need to outline the risks to them so that they understand. But if it's the only option, then under those circumstances you could see a much higher percentage of their investable wealth than would normally, I think, be acceptable. And of course, again, this came out in my case study, where you have someone who actually is in the position of they are incapable of making their own decisions. So you're looking at someone who has a power of attorney on behalf of an individual. There is huge limitations on the ability to gift. Now, if they can't give money away, they can't establish trusts, they can't really even make loans to establish loan arrangements, the reality is they can't do any form of IHT planning. Now, they could go to the court. The Court of Protection will allow, under certain circumstances, gifts to be made for inheritance tax purposes, but it's a very expensive exercise. It can be very time consuming, whereas BPR, of course, isn't a gift. It's almost unique in its ability to say, I'm investing the donor's money. And actually, if they keep it for 2 years, it's outside their estate. There is no other solution that does that. So, categorising clients is quite a difficult one. It really is down to personal circumstances.
Absolutely, makes sense. And we had a split today between BPR products that are sort of capital preservation, focused on unlisted, unquoted assets, and then we had BPR products that are investing on AIM. And we talked about the risks and benefits for each. How do you see that split? Do you think certain products are right for certain clients? Is it time of life that makes the decision? How does that work in your world?
I think from a technician's point of view, on one level I'm not the right person to ask, on another level I am. I'm not seeing clients on a day-to-day basis. So the reality is, what I can look at is what happens in practice. So if we look at the amount of BPR business that we do as a business, less than 10% actually goes into what I would call the higher risk, the AIM, which means over 90% is going into the in theory low risk. Now the risks still exist because you have liquidity risks. So on the basis that actually it is that 90 plus split, I think that dictates really that actually what most clients are looking for is for the IHT benefit and actually not to lose too much of their money. Because the converse of that is if actually they invested outside of BPR, then you're almost guaranteed to lose 40%. and that's a hell of an investment risk in a different sense.
Absolutely, makes sense. Question that keeps coming up, and I've asked it to everyone today, just around the rules, legislation and HMRC seem to have had a bit of a shift of emphasis over the last few years. What's your take on that in relation to BPR? Do you see any threats to the BPR relief?
No, I mean, it's a subject on which does concern me. And what concerns me is the fact that, you know, we have tax evasion, which is utterly illegal, everyone knows that, and we have tax mitigation, which is pretty much the phrase that going forward everyone needs to use. Tax mitigation, tax planning. And we've got this tax avoidance, which now by almost moral outrage has become the same as tax evasion. It isn't. Tax avoidance is entirely legal. What I think HMRC are trying to get at, and the mischief here, is the plethora of quite sort of aggressive, convoluted schemes that attempt to go from A to B via C and D. And that's what they're trying to get at. Things like BPR, for me, have statutory relief. They are something that is there, that has statutory legislation behind it that says, these are the rules. You have investment for 2 years, it's exempt. You know, we know what the rules are around the replacement relief. We know the type of business that will qualify. It would take primary legislation to change that, and frankly, I don't see them doing it any time. There are plenty of other arrangements that are way more aggressive that I think is their real target. I mean, and the most recent thing we've had in relation to this is the HBC. And for me, this is a great example of the sort of misunderstanding, almost mistrust that's going on. HSBC was about actually simply not declaring what people had in the way of accounts. That's not clever tax avoidance, that's actually criminality. It's money laundering, and entirely different from something like BPR, which I think people should feel safely about.
Tony, very interesting. It's always great to get your insights, and hopefully we'll speak again soon at another event. Thank you.
I hope so, thank you.